How do you determine your edge? What is an edge? You've got back-tested market data, and then you've got your real-life trading forward. When you go through your back-tested data, you're having a look at certain factors that indicate potential moves. These certain factors you look at, they become your edge. You put those into your trading plan. When you go and backtest, this is your backtested results here, you are backtesting a large sample of space of data very, very quickly. And if each of you have a look at your backtested results, you're going to have a sequence of trades. Wins, losses, wins, losses, wins. Now, hopefully, your winners are bigger than your losses, right? Wins capped max at 1%, ideally. And then your winners, maybe 3 to 1, ideally. But again, it depends on your strategy. Okay, those are the basic principles though. You want your winners to be big, you want your losses to be short. Small. Let your winners run, cut your losses quickly, okay? And you're looking at the back-tested data, you're looking at the back-tested market to determine what your edge is to give you the most profitable options, okay? Then, at the end of your back-tested data, you're gonna have a sample space, a sequence of wins and losses. At the end of that sequence is gonna be profitable, plus 18%. However, each individual trade may or may not be profitable. On the individual level, it may be a win, it may be a loss. On the larger sample space, it's going to be profitable. That's your edge. Then, when you trade real-life data, when the market presents the factors that you've backtested that align with your trading plan, you then trade it. Now, do you know this individual trade is going to be a win or a loss? No, nobody has any idea of that individual trade. There are too many factors, millions of factors influencing price in that particular moment. Nobody has any idea about the individual outcome of that trade, but the consistent replication and the consistent execution of your edge over a large sample space, you know you'll approximate the outcome of all the trades. So the individual outcome is uncertain. The collective outcome you can predict to a degree, to a certain confidence level. How many get that? That is a very important principle to understand when we talk about your psychology and your expectations. Because your expectations can't be on the individual outcome, they always have to be on the larger sample space. Remember, with your edge, you need an entry. Now, with your entry, there are going to be two components most likely. There's going to be a higher time frame area of value that you look for, and then there's going to be an entry criteria on the lower time frame. Area of value, entry criteria. Are you certain in that? Yes, no. If it's a no, what components are you not certain in? Then, you need a management style. When the price starts to run in your direction, how do you manage the trade? If price runs against your bias or your idea on that individual trade, what do you do to cut your losses quickly? You need that in your edge also. Where do you take profit? You need that in your edge. How do you manage your risk? When you go into drawdown, how do you manage your risk? When you go into profit, how do you manage your risk? You need to figure out each of those components. You need to have certainty in each of those components in your edge. If you don't have certainty in each of those components, you don't have certainty in your edge.